China and the US sling hash, but who cleans up in the end? Chinese markets flatline. I'll take their pulse. And a special look at world oil. Like a fussy patron in a busy restaurant, the USA continues to send Chinese food imports back, and the White House and Congress trip over each other with competing measures to deal with America's new filthy food problem. A panel of Bush cabinet members, including Secretary of State Condoleezza Rice, Commerce Secretary Carlos Gutierrez, and Trade Maid Susan Schwab, will look hard at the food safety problem. And at the end of this month, a delegation from the United States Food and Drug Administration, or FDA, will meet with their Chinese counterparts in Beijing for talks and perhaps lay the groundwork for uniformity and safety standards, something that is lacking and needed. But that's not enough for opportunistic politicians in Congress, such as Senator Chuck Schumer of New York, or Sherrod Brown of Ohio, who want to create an import czar to oversee the Chinese food invasion. Meanwhile, Beijing responded in its usual heavy-handed way. The party boss of the Chinese equivalent of the FDA was speedily tried and executed, and the national government is putting in place new regulations outlawing whole classes of chemicals and promising to publish daily reports of food safety in time for next summer's Olympic Games. American food imports from China are growing and are close to $3 billion in value, but China is not the #1 food import problem. India is, followed by Mexico, according to the FDA's own data. Of the top 10 rejected source countries of tainted food, China ranks third on a list that includes Denmark and Italy. One result of the food fight is that China has now joined Japan, Korea, and Taiwan in rejecting American meat. But the real danger is to the growth of USA agricultural exports to China if trade retaliation continues. China is one of the largest buyers of American wheat, some years buying up to 20% of all exports, and American corn and dairy products are counting on China for future growth. There are traces of oil everywhere, not always in commercial quantities, and no man is yet able to say what will be commercial quantities and what inaccessible territory when the automobile has finished off its mad consumption of gasoline. That day is perhaps closer than we think. That gloomy forecast comes from a report on the oil situation published in 1920 by the U.S. Geological Survey. The same report announced the USA had only 20 years yield left from onshore oil deposits and marked the first time the country began using more oil than it produced. The following year, 1921, an oil conference was held in Washington, D.C. to plan how the United States can compete against British Petroleum and Royal Dutch Shell for oil production rights in the areas with known reserves, the Middle East and Asia. Flash forward to today, and the oil reserves picture is little changed. The oil majors still competing for new fields, and the world wondering, as it did back then, if resource nationalism will end in wars for oil. One could argue that's already happening once again in Mesopotamia. Two reports out this week are fueling the peak oil debate again. First, the IEA, International Energy Agency, released a midterm report on global oil supply and demand to 2012. The report confirms the widely known fact that many of the world's most important oil reserves are in decline, particularly the oil deposits of the North Sea, affecting the energy positions of the UK and Norway and mainland United States and Mexico. Additionally, the IEA projects no increase in production in Iraq, Iran, and Venezuela. But with demand expected to continue increasing around the world, and in particular in the USA and China, with OPEC meeting it only by reaching sustained maximum production, prices must stay high and get higher still by 2012. The IEA sees Chinese oil product demand growing over 5% per year and reaching 10 million barrels per day by 2012, making China the #2 user after perennial frontrunner the USA. Chinese demand will come from a combination of growth of energy-intensive industries such as steel, increased numbers of autos, air travel, urban expansion, and up to 10 big refinery projects planned by 2012. China's oil production will also plateau but not decline at just under 4 million barrels per day. But overall, the IEA report undermines its assessment by saying that the data on China is full of uncertainties. The IEA report is pessimistic and sees no real change in the medium term. The report reluctantly accepts that there will be no replacing Middle East oil for the foreseeable future and that Europe will become more dependent on Russia for supplies in the years ahead. It also views Asia, China, and India, and the USA as direct competitors for future energy needs. Also this week, the USA's National Petroleum Council released, after a 2-year wait, its report to the USA Energy Secretary on global oil to 2030. The upshot: the Council believes global production can increase by around 25%, but only if new supplies can be exploited, particularly in the Middle East. More importantly, the report recognizes the need for energy efficiency in the USA and calls for a doubling of fuel economy in American cars and trucks by 2030. The report acknowledges that use of coal for electricity generation is here to stay and will increase for both the USA and China, with no comment on the implications for global warming. The Council's assessment is more optimistic and also focuses on the need to strengthen global and U.S. energy security. It recommends avoiding unnecessary confrontation with China, emphasizing that the USA shares vital common interests with China as an energy importer. Stock markets in China have barely moved since our last episode. In fact, the Shanghai Composite Index appears to be flatlining, having not crossed 4,000 all month. Worst hit are Shanghai B shares, down almost 1/3 since the May peak, and also flatlining around 274 points. There was a surprise jump in B shares at the end of last week. Speculation is it was bargain hunting. After all, the long-term trend remains good for Chinese shares. I'll see you next time.